Statistically speaking, if you put $5,000 on a single hand of blackjack in Las Vegas, your family stages an intervention and takes away your car keys. But if you put that same $5,000 into Zero-DTE out-of-the-money call options while sitting in your office chair on a Tuesday morning, society calls you a retail investor. Both of you are losing your money at approximately the same speed, but the guy in Vegas gets free watered-down gin, whereas you just get a screen full of digital confetti and a permanent sense of existential dread. Welcome to the modern stock market, a gambling addiction masquerading as a sophisticated financial career. To understand how we got here, we have to look back at the boomer era. This was a time when the stock market was for people who wore beige sweaters and enjoyed the sensation of watching grass grow. This is the traditional investor. He knows exactly two things: time in the market beats timing the market, and dollar-cost averaging is the path to salvation. If he had to get a tattoo, it would say, "Buy the dip," but he would never do that because tattoos are a sin. His entire strategy is a 1% growth rate that might allow him to buy a house by the time he is 90 and no longer has the teeth to eat solid food. It is safe, it is linear, and it is incredibly depressing.
Then technology happened. Specifically, developers realized that looking at a brokerage account shouldn't feel like doing your taxes. It should feel like playing a video game. They turned the user interface into a dopamine delivery system. Now, you aren't speculating on the macroeconomic shifts of the tech sector. You're playing a slot machine that lives in your pocket. This is where we see the rise of loss porn, the weirdly common tradition on the internet where people post screenshots of losing their entire life savings in a single afternoon just to feel the warmth of 10,000 strangers laughing at them. It is not about the money anymore. It is about the high of the gamble.
To make ourselves feel like we aren't just degenerate gamblers, we invented something called technical analysis. This is essentially astrology for men. You will see guys on the internet drawing neon-colored triangles and support lines over a chart that is clearly crashing to zero, claiming that a Fibonacci retracement or a golden cross predicts a massive rally. In reality, it is just a ritual to distract us from the fact that a single tweet from an eccentric billionaire or a minor interest rate change from the Federal Reserve can liquidate your entire net worth in the time it takes to order a burrito. It is a psychological coping mechanism for people who can't admit the house always wins.
If the stock market is a casino, you have to ask who the house is. Enter the Theta Gang and the Quants. Theta Gang consists of the people who realize that most of the to-the-moon crowd are just buying lottery tickets, so they become the ones selling those tickets. They use terms like iron condor and gamma hedging to maintain a feeling of intellectual superiority while they slowly drain your account of its value. Then you have the Quants, MIT graduates with 3 PhDs who spent $500 million running a fiber optic cable that is exactly 14 feet shorter than their competitors, just so they can arbitrage a quarter of a cent profit before your phone even registers the price change. You aren't playing against other nerds. You're playing against a sentient algorithm that thinks in nanoseconds.
So why do we do it? We do it because the safe path of the boomer investor feels like a lie. When a starter home in the United States costs $800,000, a 7% annual return on your $500 savings account isn't an investment, it's a trifling statistic. We gamble because the casino feels like the only place where the odds aren't already 100% against us. Of course, I'm telling you this while I also have $40 left in my own savings account because I thought Zero-DTE meant zero risk. If the world is going to end in an economic collapse, we might as well have a front row seat. Subscribe for more trifling statistics. Or don't. The market will probably crash either way.